Hey everyone, it's Chris from Smithy Fitness. Welcome back to my channel. Maybe I should be calling this one Smithy Finance. It's going to be part 2 of my series on the stock market and talking about this phenomenal book. Now this book was written in 1960 and it was out of print for many years. And in fact, during my early brokerage years, 84 through 90, I was going to bookstores regularly and buying up books on the market and trying to figure things out as best I could. And I never saw the book there. It was never there. And it wasn't until the late 90s, mid to late 90s, that I went to the research library in Toronto. You can't sign any books out. It's a huge library, 8 floors. It's magnificent. And I was there, been sort of struggling with my business as a stockbroker, as I said. And I went into their section of investment books trying to find the answer. And I found a very old, beaten up copy of this book. And you're not allowed to sign anything out there. So but I was experimenting with lots of different books, and I took that one out. And I started to read it, and I devoured it in about 4.5 hours, taking notes, and it just sang to me. I knew that I was onto something. So it wasn't until later that we were able to buy the books. It went back into print, and I found it online, and I've just been reading it. And having my young son, my 21-year-old son, has already read it 2 or 3 times and is well on the path. So strongly recommend. Now the book starts with Darvas talking about what not to do in the market. And I think that's really important. So what not to do? Listening to stockbrokers, investment advisors. Okay, and again, I was one, and I really wanted my clients to make money. But you have to understand, a stockbroker or investment advisor is really a salesman. We would get information from the research department, and they would say, these are great stocks, go sell them, go sell the idea to your clients. We were 100% commission. There was no salary, so we had to make sales, and we had to have ideas that were exciting to the clients, but we weren't doing the research. The research was done by the research part of the business, and we were on the phone trying to convince our clients that this was a good buy. And there's nothing that a broker wants more than for his clients to make money. Boy, that research, it worked out not very often, maybe 40% of the time. So we don't want to listen to stockbrokers. We want to become self-sufficient. So that's number one, and Darvas found that out the hard way. He would buy some stocks, Wall Street broker, and the stocks often went down. So that wasn't the answer. And then there's the what we used to call the tout sheet or the newsletters. And you can subscribe, I'm sure you've seen them. $199 a year, maybe $900 a year, maybe $3,000 a year, and you'll get right to your email box tips and insights into the stock market. And again, these don't work very well. You really need to be able to make your own decisions. When you're relying on someone else, if the stock starts to go down, you don't know why, you're kind of flustered, and you have no gravitas to your purchase. And I've got a couple of examples of that, and I think it's important. I had subscribed to Joseph Schachter's Schachter Energy Report in Canada. Now, Schachter lives in Calgary. He's in touch with all the oil and gas companies there, and he's very persuasive. He's got graphs and charts and historical data, future expectations. I became a little bit mesmerized with him, and I paid for it in a huge way. Schachter has been wrong for years. We had one stock called Bellatrix. I bought it. It was a table-pounding buy at $4, $2, $1. No way they're going bankrupt. Things are great. It's only a matter of time. 50 cents, bankrupt, out of business. And I had bought it all the way down. And this was only a few years ago. Another example is the great Jesse Livermore. This is another great book that should be read, and maybe I'll do a series on this down the road. But Jesse Livermore, the greatest investor ever, was short the 1929 crash and bought it all back right at the bottom, made a fortune. But even he, in his wisdom, was sucked in to a market wizard, a market expert. His was cotton. He had been short cotton. He was talked into going long cotton, kind of lost his mind a bit, kept buying it, and took hundreds of thousands of dollars of losses. So tout sheets don't work. Right now we've got, Twitter, and the internet is Reddit, etc., full of ideas, full of hot tips. Careful, okay? Careful. Not the way to go. So that's the first two, tips from your neighbors, your brother-in-law. Ignore them all. Livermore had a saying, don't give tips, don't take tips. Again, it needs to come from within. You need to find your own ideas and go on them. So Darvas's next part of his evolution was was doing his own fundamental research. And he would look at different companies in different industries and look at the balance sheets and, how much debt do they have? What's the expectations for their future earnings? What's their dividend? What's their price earnings ratio? What's their price to market cap? All the different ratios that us economics guys would use to rate a balance sheet. And Darvas really thought that he had it figured out. He found one company, I think it was called Jones and Laughlin. It was a steel company, a 6% dividend. It was only trading at something like 6 times earnings, blah, blah, blah. It looked fantastic. He mortgaged his house. He took a loan against his life insurance. He got an advance on a contract. He was a dancer, and he took an advance on a contract he had where he was going to be dancing periodically over the years. And he put all his money using margin into this stock. And wouldn't you know it, it promptly went down. He ended up losing $9,000, which in 1955 or 56 was a huge amount of money, and he was staring at bankruptcy, didn't know what to do, very discouraged. He had done all this work, and he would study hours and hours, hundreds of hours. He became obsessed, as often you have to do if you want to have outsized success. You need to become obsessed. So in any event, it almost broke him. But he had to make a comeback. He didn't know what to do. He kept looking at the stock pages. In those days, of course, the stocks were printed in the newspapers. Now you can get it online, of course. But it would have every single stock on the New York Stock Exchange or Toronto or wherever, the high, low, closing price from the day before. And he would be looking at the lists, and there's thousands of stocks. And one day, one company stood out. It just kept going up. He had noticed it in previous days. It would go up 25 cents, up 50 cents, maybe up $1. He knew nothing about it, had never heard of the company. He thought it was at 37 bucks. He says, I don't know anything about this, but it's going up every day. I'm going to buy some. It was almost out of desperation. Well, he bought 1,000 shares at $37. And 5 weeks later, he sold it at 44. He made something like 6,500 net, and it blew his mind. He said, what is the point of doing all this work, all this analytical work, reading all these reports, looking at the balance sheet, maybe even phoning the company and asking how's business? What's the point if all you need to do is find a stock that's going up and hop on board and stay with it for a while and then sell it? And that was the beginning of the Darvas method. Forget all that other stuff. Let's look at the stock charts. Let's not listen to all the BS that you hear from all quarters. Let's look at the stock page and make a hard decision based on the numbers and based on the trend of the stock. So that's it for this one, guys. That's the beginning. Next time we'll get into Darvas's box theory, and we'll start to see how it worked for Darvas, but how it can work in modern day times as well. All right, so thanks for tuning in. Great to see you, and I'll talk to you in the next one.